Year to date, markets are down big, and that's panicking a lot of investors. But for the savvy investors, down markets are not just another opportunity to add more money and buy things at a more reasonable price. It's also a great time to lower their current and possibly future tax bills. This strategy is called tax loss harvesting, and it allows you to offset capital gains with capital losses. Now, before I dive into it any deeper, I want to preface this by saying I am not a tax expert, so before you utilize this strategy, please make sure you consult your CPA or tax professional. So, tax loss harvesting generally works like this. You comb through your portfolio and you find securities or investments that are currently at a loss, and you sell them to lock in that loss. Now, these securities are usually a single stock or a fund or an ETF, for example, but they can also be more than one. That loss that you've locked in can be used to offset taxable gains and potentially up to $3,000 of your taxable income. So here's an example. Let's say you bought a security for $50,000 and now it's at $35,000 and you sell it. You've sold it at a $15,000 loss and you've locked that loss in. Now, let's say in your portfolio you have other securities that have a gain that you've sold. And let's say the total gains that you have for the year that are taxable are $7,000. The $15,000 loss that you have can offset the $7,000 gain, meaning that the losses wipe out the gains. Now, your capital gains for the tax year are zero, and you're not going to be paying taxes on that. So we took a $15,000 loss, we offset it with $7,000 of gains, we removed the gains and removed that taxable event, and now we still have $8,000 of loss left over. Now, each year, the IRS allows you to take $3,000 of that loss and use it to lower your ordinary income. So for example, if your income at this point is $100,000, you can take up to $3,000 of the available losses and lower your taxable income that way. Your $100,000 income now becomes $97,000 for tax purposes for the year. But wait, there's still $5,000 of losses left over from the original 15. We had 15, $7,000 of which was offset because those $7,000 were gains. We removed $3,000 for income purposes to lower our income. There's still $5,000 in losses left over. Well, those losses are not lost. They will carry over to the following year, next year, and they can be used to offset any future gains that you have. So again, we combed through our portfolio, we found an investment that had a loss, we sold it at a loss, and used that loss to offset capital gains for the year, meaning that we're not going to pay taxes on those gains. We also used it to lower our income for tax purposes, and the remaining loss that wasn't used is now able to be carried forward to future years to offset future gains. So now that we understand tax loss harvesting and how it works, what should I consider when I'm thinking about utilizing this strategy? Number one, you can only do this in taxable accounts, brokerage accounts, for example. You cannot do this in retirement accounts because retirement accounts grow tax deferred and have that tax benefit. So there's no tax loss harvesting in retirement accounts like your IRAs and 401ks. Tax loss harvesting can only be done in taxable accounts, for example, like a brokerage account. The second important thing that I want you to remember is the wash sale rule. This rule says that you cannot sell a security and then buy the same or substantially identical security 30 days before or after the sale. This is an IRS rule that if you break the rule, it disallows the tax losses that you were trying to harvest. So in the example that we gave before, if you had that $15,000 loss and you immediately went back and bought the investment, the same exact investment, that $15,000 loss is now disallowed. You have to wait a certain amount of time to be able to repurchase that same identical investment. So when should I utilize the tax loss harvesting strategy? As I always say, it depends. Your situation is unique and needs its own personalized attention. What works for one person or a household may not be the best strategy and may not work for you. And also, really, really important, when you're thinking about this strategy, you want to make sure that you're harvesting losses but still following the same investment plan that you've set out beforehand. the same primary investment strategy that you've decided on, because that strategy is what's getting you towards your goals. It's what's allowing you to accomplish the things that you want to accomplish. And so when we do tax loss harvesting, we want to make sure that we're not disrupting our investment process, and we're doing these things to complement the overall process and strategy, not take away from it. Tax loss harvesting can be a very powerful strategy to help you offset gains and your income. It's a great way to manage taxes in a down market and take advantage of down markets. If you have questions on tax loss harvesting, if you have questions on how it works or if it would be beneficial to you, make sure you reach out to your trusted financial professional, your financial advisor, and your tax professional. Thank you so much for tuning in, and take care. I'll see you soon.